Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey everyone, and welcome back to the 5-Minute Prime Podcast. I'm your host, Martin Maxwell. Today, we're diving into a number that should make anyone interested in real estate sit up and take notice, 11.3%. That's the delinquency rate on FHA loans in the fourth quarter of 2024, as reported by CNBC. So what are FHA loans? Why is that 11.3% number so alarming? And most importantly, what does it mean for you, whether you're a potential home buyer, a current homeowner, or a real estate investor? Let's break it down. Let's start with the basics. FHA loans are insured by the Federal Housing Administration. This means the government is essentially backing these loans, protecting the lender if the borrower defaults. This allows lenders to offer loans to people who might not otherwise qualify. Now, let's compare them head-to-head with conventional loans, which are not government-backed. FHA loans often have lower credit score requirements. You can potentially get an FHA loan with a credit score as low as 500 with a 10% down payment, or 580 with just a 3.5% down payment. That's significantly lower than what most conventional loans require. And that 3.5% minimum down payment, that's a major draw for many first-time buyers who haven't had time to accumulate a large down payment. FHA loans are also generally more flexible when it comes to your debt-to-income ratio. Conventional loans, on the other hand, typically require higher credit scores, generally 620 or higher, and you'll get the best interest rates with a score above 740. They often require larger down payments as well. While some conventional loans do offer low down payment options, many require 5%, 10%, or even 20%, especially if you're buying an investment property. So on the surface, FHA loans seem much more accessible. But, and this is crucial, there's a catch: mortgage insurance. FHA loans require two types of mortgage insurance: an upfront premium that you pay at closing and an annual premium that you pay monthly. And for most FHA borrowers, that annual premium continues for the entire life of the loan. With a conventional loan, if you put down less than 20%, you'll likely have private mortgage insurance, PMI, but you can usually get rid of it once you reach 20% equity in your home. That difference in mortgage insurance is a significant factor. It adds to your monthly costs and can make FHA loans more expensive in the long run. But that's not the only reason FHA default rates are higher, though. That 11.3% delinquency rate for FHA loans compared to just 2.63% for conventional loans in the same period, it's not a coincidence. It's a direct result of the type of borrower FHA loans are designed to serve and the broader economic forces at play. First, you have the borrower profile. FHA loans attract borrowers who are often considered higher risk by traditional lenders. They might have lower credit scores, less savings, and higher debt-to-income ratios. This isn't a criticism, it's simply a fact. These borrowers are often more vulnerable to economic downturns or unexpected life events. Then there's the issue of skin in the game. With a smaller down payment, FHA borrowers have less equity in their homes initially. If home values decline, they're more likely to find themselves underwater. And unfortunately, this can sometimes make it more tempting for borrowers to walk away from the loan. We also have to consider broader economic headwinds. Factors like job losses, inflation, which we've discussed extensively, and rising interest rates disproportionately impact lower and moderate income households, the very people FHA loans are intended to help. The CNBC report we referenced earlier highlights this very point. While the overall mortgage delinquency rate is relatively low, the FHA delinquency rate is more than 4 times higher. And you have to think about the aftermath of COVID and forbearance programs that were offered. This high default rate isn't just an isolated problem for individual borrowers. It has broader implications for the housing market and the economy. Let's explore those next. When a significant number of FHA loans go into default, it creates a ripple effect throughout the system. The FHA doesn't actually lend money, it insures loans made by private lenders. So when borrowers default, the FHA has to pay out claims to those lenders. A sustained high level of defaults could put a significant strain on the FHA's financial resources, potentially requiring government intervention. There is also the potential for tighter lending standards. If lenders start to see FHA loans as increasingly risky, they might tighten their lending standards, requiring higher credit scores, larger down payments, or charging higher fees. Ironically, this could make it harder for the very people FHA loans are designed to help to actually qualify. And there is a broader impact on the housing market. A surge in foreclosures, especially if concentrated in areas with many FHA loans, can put downward pressure on property values for everyone in that area, not just FHA borrowers. Whether you're considering an FHA loan as a home buyer or you're a real estate investor analyzing the potential impact of FHA defaults, here's what you can do to protect yourself. If you're a potential FHA borrower, supercharge your finances before you apply. This is absolutely critical. Work on improving your credit score. Remember episodes 11 and 12. Pay down as much high-interest debt as possible, episode 9, and build up a substantial emergency fund. Be realistic about what you can afford. Don't stretch yourself to the absolute limit. Factor in all the costs of homeownership, including property taxes, insurance, and potential maintenance. Understand your loan terms completely. Read the fine print, know your interest rate, your monthly payments, and the terms of your mortgage insurance. And perhaps, most importantly, communicate with your lender. If you do run into financial difficulty after you've bought a home, don't ignore the problem. Contact your lender immediately to explore your options. There may be programs available to help you avoid foreclosure. For real estate investors, factor in FHA default rates when analyzing markets. Be aware of the potential for higher foreclosure rates in areas with a high concentration of FHA loans. Diversify your portfolio. Don't put all your eggs in one basket. Consider different property types and different markets. And focus on strong fundamentals. Look for properties with solid cash flow potential in areas with strong economic fundamentals. The key takeaway here is to be proactive, be informed, and be realistic. Don't let fear paralyze you, but don't be overly optimistic either. So let's recap. FHA loans can be a valuable tool for achieving homeownership, especially for those who might not qualify for a conventional loan. But they do come with higher risks, and that 11.3% delinquency rate is a serious warning sign. It's a reminder that financial stability and careful planning are essential no matter what type of loan you choose. Okay, here's your challenge for today. If you're considering an FHA loan, I want you to do two things. First, pull your credit report and really look at it. What's your score? What can you do to improve it? Second, use an online mortgage calculator to compare the total cost of an FHA loan versus a conventional loan, factoring in the lifetime mortgage insurance. And if you're an investor, research the FHA loan concentration in your target markets. Is it a significant factor? How might that impact your investment strategy? And as always, if you found this episode helpful, please subscribe to the 5-Minute Prime podcast, share it with someone who's thinking about buying a home, and leave us a review. You can find more resources and tools at reiprime.com.